The call came in as a United States cargo ship fully loaded with soybeans was making its way across the Pacific. A quiet alert lit up trading terminals in Singapore. China cancels all U.S. soybean shipments, effective immediately. By midday, 2.4 million tons were diverted to Brazil, and by nightfall, $1.1 billion in American farm deals had evaporated. This wasn't a trade war, it was a controlled demolition. And soybeans? That's where the fuse was lit. Over 40 vessels were rerouted and a multi-billion-dollar trade artery snapped like a brittle twig. This wasn't a fluke in trade systems. It was a clear message. And it wasn't just farmers who noticed. Wall Street was watching. The Pentagon was watching. When your biggest buyer halts deliveries without blinking, that's not negotiation. That's a stress test. And America was the first to crack. Bloomberg broke the story. China had suddenly canceled orders from 3 of the largest U.S. soybean exporters, Cargill, ADM, and Bunge, citing strategic procurement shifts. Within days, Chinese firms had purchased 2.4 million metric tons of Brazilian soybeans, valued at over $1.1 billion, according to S&P Global Customs data. That volume alone makes up about 1/3 of China's typical monthly soybean imports. While Beijing didn't officially call it retaliation, this move came less than 48 hours after President Trump rolled out a fresh round of tariffs, this time targeting $90 billion in Chinese goods. Analysts at Rabobank now warn this may not be a one-time maneuver. It could be a strategic pivot designed to break U.S. agricultural dominance for good. And the impact in the United States immediate and visible. According to the USDA's April 2025 report, unsold soybean inventories jumped by 13%, marking the highest April stockpile since 2019. Spot prices on the Chicago Board of Trade fell 8.2%, erasing over $470 million in value in a single week. In Iowa, farmer sentiment hit a wall. "We got cut off mid-season with no backup plan," said Matt Dunn, a fourth-generation grower in Des Moines, during an interview with the Wall Street Journal. "This isn't a trade issue anymore. It's economic isolation." The American Soybean Association now warns that this Chinese pullout could slash farm income by as much as 18% in just this quarter. So now the real question is, how deep does this go? President Trump's 20% tariff on Chinese electronics metals and electric vehicle components, announced March 10th, was meant to pressure Beijing before trade talks. Instead, China hit back with precision, targeting one of the last U.S. exports they still depended on: agriculture. And soybeans weren't just any crop. In 2024, the U.S. exported $14.3 billion worth of soybeans to China, making it the largest single export category in the entire U.S.-China trade relationship. China is going after Trump's political stronghold, rural America and farm states, said Chad Bown, senior fellow at the Peterson Institute, in an April 2nd interview with CNBC. On that same day, the USDA confirmed that farmers across 11 Midwestern states are now at moderate to high risk of insolvency, thanks to canceled forward contracts. As the pressure rises, one question looms. Is this trade war turning into a political disaster for Trump at home? Let's pause. Not because the story has slowed, but because it's taken a new form. This isn't just about soybeans anymore. It's about strategy. Brazil's preparedness wasn't a stroke of luck. It was the result of careful planning. Between 2020 and 2024, Brazil grew its soybean acreage by 21%, supported by more than $11.2 billion in investments toward agricultural infrastructure. China's state-run development banks played a major role. They funded grain terminals in Santos, improved freight routes from Mato Grosso, and co-financed the Ferro-Grão Railway, which helped reduce internal shipping times by 42%, according to a Reuters report published in February 2025. This infrastructure laid the foundation for China's shift. In fact, Bloomberg Intelligence now estimates that Brazil is capable of covering up to 70% of China's annual soybean needs. With fewer restrictions on GMOs, more relaxed environmental rules, and stronger trade protections through BRICS agreements, Brazil's rise may not just be a phase, it could be permanent. So is the U.S. being slowly replaced, not just outpriced, but outmaneuvered? The timing says a lot. From March to June, U.S. soybean exports are usually at their highest value, making up nearly 40% of annual export income, according to USDA trade data. By cutting imports during this critical window, China triggered a sharp market sell-off, just as U.S. exporters were trying to move the most product, impacting both prices and volumes. Meanwhile, Brazil's harvest wasn't even fully underway. China knowingly paid a premium, reportedly between $14 and $22 more per ton, based on interviews with traders in the Financial Times. So why would China overpay? According to Minu, a trade expert with China's Ministry of Commerce, short-term losses can lead to long-term control. In this light, it wasn't just about soybeans, it was about influence. Officially, China pointed to phytosanitary issues, claiming quality concerns due to fungal residue and pesticide traces in United States shipments. But as of April 2025, no such violations had been confirmed by the USDA or the WTO complaint registry. In fact, United States soybeans routinely meet global food-grade standards, with contamination rates staying below 0.01%, based on a joint audit from the FDA and GAFTA. Trade experts still aren't convinced. There's very little precedent for safety-related bans being rolled out without prior inspections or formal warnings, said Andrew Tilton, chief Asia economist at Goldman Sachs. By using non-tariff barriers, China avoids direct World Trade Organization challenges while also sending a message of unpredictability to American exporters. So the real question is this: is this truly about food safety, or is it a veiled act of economic retaliation dressed up in regulatory terms? Let's look at how China is quietly turning soybeans into a form of global power, not just at the negotiation table, but through ports, railways, and billion-dollar infrastructure moves. China's shift away from U.S. soybeans didn't begin with a trade talk. It began at the docks. In the last 5 years alone, China invested over $8.3 billion into transportation infrastructure across Latin America, according to the Inter-American Dialogue. This includes a major stake in Brazil's Port of Itaqui, a $1.22 billion upgrade to the Northern Grain Corridor, and direct funding of the Ferrogrão Railway, which cuts transport costs from Mato Grosso by 35%. These aren't just logistical routes, they are strategic corridors. By embedding itself directly in the infrastructure that moves Brazil's soybeans, China is reducing not only its reliance on U.S. crops, but also its exposure to global trade choke points often influenced by the U.S. The results are already visible. In 2024, more than 64% of China's soybean imports came through routes where Chinese firms had direct involvement, according to customs data reviewed by Bloomberg. As one analyst from the Carnegie Endowment put it, China isn't just buying food anymore, it's buying leverage. But here's the real issue keeping U.S. strategists up at night. What if soybeans are just the opening move, not the end goal? While soybeans dominate the headlines, corn is quietly exiting the picture. Between January and March 2025, U.S. corn shipments to China dropped by 29% compared to the same time the year before, based on the USDA's latest data. During that same period, China sealed a 3-year deal with Brazil's CONAB agency to import up to 9 million tons of corn annually, a deal worth an estimated $2.66 billion, according to a Reuters report from March 28th. And this isn't an isolated case. In March, China's state grain reserves sold off 1.2 million tons of U.S. corn, blaming unstable prices and a need for strategic rebalancing. Insiders say the bigger problem is trust. After facing years of trade tensions, tariffs, and export restrictions, Beijing increasingly views American agriculture as a risky bet. This isn't just diversification, it's insulation, said Joseph Glauber, former chief economist at the USDA, in an interview with the Wall Street Journal. And that raises an even bigger concern. If corn is on the way out, what's next? Wheat? Sorghum? This shift hints at something deeper, a structural change that U.S. markets may only just be starting to reckon with. U.S. officials say the door is still open, but China's recent actions tell a different story. According to HSBC's April 2025 Commodities Report, China has now signed or extended long-term import deals with countries like Argentina, Brazil, Russia, and Pakistan, agreements that now supply over 70% of its grain and oilseed demand. Meanwhile, U.S. farm exports to China dropped sharply, down 26% just in the first quarter of 2025, cutting $3.2 billion from trade flows, based on Census Bureau numbers. Some experts think improved diplomacy could change things, but even if tariffs were removed tomorrow, China already has the infrastructure and the motivation to move on. This isn't just about lowering risk anymore. It's about cutting ties, said Jennifer Harris, a former National Security Council advisor, in a conversation with Bloomberg. With political tensions locked and the BRICS Plus alliance offering new options, the real question isn't whether the U.S. can win back trade. It's whether China even wants to return. Now think about this. What if soybeans were only the start? What if the real shock is still ahead? This wasn't just a trade argument, it was a test run. China proved it could walk away from a $14 billion US commodity and replace it in just 72 hours. No delays, no shortages, no backlash at home. So what happens when China does this with semiconductors, with rare earth materials, or even US government debt? What happens if the next shift isn't about agriculture, but about the dollar itself? That's not just a concern for farmers. It's a warning sign for Wall Street and policymakers in Washington. Because if this was just step 1, what does step 2 look like? Stay with us. If soybeans were just the beginning, the dollar could be next. If you're finding this video helpful, don't forget to like and subscribe.